Have you been asked to find the current ratio for a company and you're not quite sure how to do it? Well, you've come to the right place because I'm Professor Capko and I'm going to show you exactly how to find the current ratio of a company in today's video. But first, I want to say something wonderful is about to happen for you. So be on the lookout for it. And now, back to the video. In this example here, we're going to look at a balance sheet for a company and calculate the current ratio. We've got the assets, the liabilities, and the owner's equity listed here. And we're asked to find the current ratio for the company. Let's look at what the formula is for current ratio. Current ratio is the current assets divided by the current liabilities. Let's talk about what current assets are and current liabilities. Let's first look here at the assets. If you're not familiar with a balance sheet, I've got a video linked up here in the corner that will give you some of the balance sheet basics. It's a good starting spot. Let's talk about the assets first. We have all kinds of assets listed here from cash, prepaid expenses, plant assets, and others. We only want to concern ourselves with what are called current assets. What are current assets? Current assets are assets that are either cash or can be turned into cash relatively easily within 1 year. So things you might expect to turn into cash within 1 year. For example, of course, cash, accounts receivable. Of course, those are accounts that your customers owe you, and hopefully they're going to pay you within a year. Inventory, most companies will try and sell their inventory and hopefully sell it through within a year. And any kind of prepaid expenses, maybe some prepaid insurance, prepaid rent, things like that that you're going to use up within the year. In this case, we've got the current assets broken out, and it's $990,000. Sometimes the balance sheet will not break it out for you, and you'll have to find them and add them up yourself. So that may be the case, but understand that that's what current assets are. By contrast, long-term assets such as plant assets are looked at separately. They are things that aren't easily turned into cash within a year. Maybe they're equipment, maybe they are trucks or vehicles, maybe they're the company's factory. That's a plant asset. And if the company were to sell that plant, it might take a while to sell it. You know, a big, large factory might take a while to sell. If you tried to sell it in a year, you might not get its full value. So those are not considered current assets. They're considered long-term or plant assets. In current ratio, because it's a current ratio, we're looking at the current assets. Likewise, liabilities, we've got current liabilities and long-term liabilities. Current liabilities are liabilities that are going to be paid within a year. They may be accounts payable, maybe you purchased something from a vendor and you're going to be paying that off maybe within 30 days. Most vendors require you to pay stuff pretty quickly. Taxes that are owed, maybe it's wages that are going to be paid at the end of the week. Things such as that. These are current liabilities, an electric bill that's going to be paid by the end of the month, as opposed to long-term liabilities, such as maybe a long-term note that's payable over many years, maybe a mortgage that's payable over 30 years, things like that that are long-term. We are only going to concern ourselves with the liabilities that are current liabilities that are going to be paid within a year. And again, we've got this broken out. Not every balance sheet breaks it out. You may have to identify current liabilities and add them up yourself. We're not going to concern ourselves with owner's equity for this calculation. We only need the current assets and the current liability. And as I mentioned to you, our formula for that is current assets divided by current liabilities. Thank you for that thumbs up. That really helps the channel. It's very much appreciated. Let's fill in our numbers here. So I've got the formula here. I'm just going to fill it in right next to it. And our current assets, which are on top, is 990,000. So I'm going to write that here, 990,000. And on the bottom, our denominator is the current liabilities. In this case, we know that they're 115,000. And all we need to do is divide those. I'm going to pull out my BA2 plus calculator to do it. If you want a calculator like this, I've got one linked down in the description or on the screen. You can just click on that link and get yourself one of these. It's an excellent calculator. Let's start out with the 990,000, which is our current assets, and I'm going to divide by the 115,000 in current liabilities, and we wind up with a current ratio of 8.61. Now, depending on how accurate this needs to be is where you're going to round it. Generally, it might be to one decimal place. So in this case, it would be 8.6. I'm going to put that here, 8.6. That's how you calculate the current ratio. What does it mean? Well, this is one way for finance professionals, investors, accountants, people like that to figure out the health of a company. And the larger this number, the more it is above one, the healthier the company is in general, because this is showing you that our current assets, the amount of assets we have that we could convert into cash, is larger than the amount of current liabilities that we have to pay within a year. So any number above one would indicate a healthy or somewhat healthy, relatively healthy company. If the number was below one, then it would indicate that our liabilities that are current that need to be paid in a year are higher than the amount of current assets we have. And we might have to either dig into long-term assets and sell them, perhaps even at a loss, or they may have to borrow money to pay off the current assets. So what amounts to a healthy or a good investment, that depends on the industry. Some industries might have a higher current ratio than others, and you're going to generally compare companies that are in the same industry to decide what a good current ratio is. And what exactly is a good current ratio is really outside the scope of this video. I'm merely showing you how to calculate the current ratio and what it means. And you would look at that and look at the current ratio for a company to decide how that company is doing. Once again, the formula for it is current assets divided by current liabilities. That's all I have for you in this video. If you'd like to support the channel, you can become a member. There's a join button next to the subscribe button. If you click on that, you can see the various levels of membership. Members have some great benefits such as early access to videos. There's some member-only videos that I do, as well as they get priority for questions getting answered. So if you've got a particular question you want answered and perhaps you need a video made, I'm going to give priority to the members for this channel. If nothing else, I'd love to have you subscribe to this channel, share this video with someone who you think might get some use out of it, and hit that notification bell so you never miss a video. Thank you.